If you are a shareholder in Thai Beverage, you probably choked on your morning coffee when you saw the headline yesterday. Net profit down 6.8%, revenue slipping, and a stock price that just seems stuck in the mud, refusing to break out. When you see a blue chip company, the elephant in the room, posting negative growth numbers while the cost of living is shooting up, the immediate instinct is fear. Is the business broken? Is the consumption story in Southeast Asia dead? If you are just reading the headlines, it looks like a signal to cut your losses and run. But if you strip away the noise and look at where that money actually went, the story changes completely. The decline wasn't due to a broken business model. It was a deliberate strategic choice to burn cash now to secure dominance later. In fact, if you look at the series build contract won by Seatrium or the debt maneuvering by Singtel on the same day, a very clear picture emerges. The market is separating into those playing defense and those building a fortress for 2030. What looks like a stumble might actually be the setup for the next leg of growth, but only if you know which numbers to ignore and which ones to watch. I'm Iggy, your Singapore-based market analyst, and my job is to cut through the noise, ignore the clickbait, and show you what really matters for your CPF, SRS, and SGX portfolios. And we've been putting in the work to do exactly that. Since October 2025, this channel has produced over 1,200 videos with more than 600,000 watch hours. We were also honored to be ranked 8th in Tiger Broker's 2024 Influential Tigers. My focus is always on regional and global trends to give you that broader context so you can uncover hidden gems and potential pitfalls. Today, we are going to do exactly that with a deep dive point-by-point analysis through the latest moves from Singtel, Seatrium, ThaiBev, and ComfortDelGro to see how they fit into your 2025 portfolio. Let's start our methodical breakdown with the defensive anchor of many Singaporean portfolios, Singtel. If you follow the local telco space, you saw the news that Optus, Singtel's Australian unit, priced $200 million in 10-year fixed notes. Now, on the surface, a bond issuance sounds incredibly boring. It's the kind of news that makes most retail investors scroll past. But we need to pause here because the Iggy perspective is that this specific transaction tells us everything we need to know about Singtel's current power. First, let's look at the coupon rate. They secured this debt at 2.48%. Let's define why that matters. In a world where risk-free rates in many developed economies have been hovering much higher, and where corporate borrowing costs have eaten into margins for years, securing 10-year money with a 2 handle, meaning under 3%, is exceptional. This is an absolute flex of credit strength. It tells us that the bond market, which is often smarter than the stock market, views Singtel as a rock-solid borrower. But the analysis goes deeper. The proceeds are being swapped into Australian dollars. Why? Because Optus operates in Australia. By swapping this SGD debt into AUD, Singtel is effectively matching its liabilities to its revenue base. This is what we call natural hedging. It means that if the Aussie dollar fluctuates wildly against the Sing dollar, Singtel's balance sheet is insulated because their debt payments and their income are in the same currency. So, for us as Singapore investors, this is exactly what you want to see. This isn't just borrowing money to plug a hole. This is using financial engineering to lock in cheaper funding costs and lengthen their debt maturity profile out to 2035. This reduces refinancing risk during the volatile periods we expect in the coming years. My verdict here is neutral to positive. It doesn't scream buy now for capital gains, but it reinforces the thesis that Singtel is a defensive yield play with disciplined capital management. It protects the dividend floor, which is the only reason most of us hold it. Next, let's pivot to the growth engine, Seatrium. The headline here is that Seatrium has officially bagged the Tiber Floating Production Unit, or FPU, contract from BP. This pushes their order book for FY 2025 comfortably above this $2 billion mark. But the dollar value isn't the most important part of this story. The most important phrase in this announcement is series build. Let's define that. In the offshore marine industry, projects used to be first of kind. Every oil rig, every floating production unit was a bespoke custom prototype. That is a nightmare for margins because you have to engineer everything from scratch and mistakes are expensive. Series build means they are copying a previous design. In this case, over 85% of the ThaiBev design will mirror the previously awarded Kaskida project. Why does this matter? It's the industrialization of offshore engineering. By replicating the Kaskida design, Seatrium drastically cuts engineering hours. They don't need to reinvent the wheel. They reduce procurement risks because they are ordering the same parts again. This implies significantly higher margins on ThaiBev compared to a bespoke project. From my perspective, this is the validation of the post-merger investment thesis. We bought into Seatrium, formerly Sembmarine and Keppel O&M, because we believe the consolidated yard could dictate terms and drive efficiency. This contract proves it. They are becoming the Ford Model T assembly line for complex energy transition assets. I am bullish here. With the order book replenished and repeatable designs improving efficiency, the path to consistent profitability is clearer. Watch for better cash conversion in upcoming quarters. Now, we have to address the elephant in the room, Thai Beverage. This was the source of the scary headline I mentioned at the start. FY 2025 net profit fell 6.8% to 25.4 billion baht. Revenue slipped 2.1%. If you're holding this stock, you are frustrated. It feels like dead money. But we need to analyze why the profit dropped. It wasn't an operational failure in the sense that the factory stopped working. The drag came from two specific areas: softer consumer demand in Vietnam and Thailand, and intentionally higher brand investment costs. Let's unpack brand investment. In corporate speak, this means marketing, advertising, promotions. When the economy is bad, weak companies cut marketing to save money. Strong companies spend heavily to steal market share from the weak ones, accepting lower profits today for dominance tomorrow. This is a classic pay now, gain later scenario. The good news is that beer margins are actually benefiting from lower input costs. Raw materials are getting cheaper. But ThaiBev isn't banking that money as profit. They are reinvesting it into the brand war. The bad news, and we have to be honest here, is that the macro environment in Indochina is still sluggish. The Vietnamese consumer has not fully woken up yet. So what is the verdict? It's a hold or accumulate for the patient, long-term investor. The brand equity is intact. Their Passion 2030 roadmap is still in play. If you want income stability, the dividend is safe. But if you are looking for immediate growth, you will be disappointed. You are waiting for the macro cycle in Thailand and Vietnam to turn. Finally, let's look at a very interesting development with ComfortDelGro, or CDG. The news is that CDG's China arm signed an MOU with Hello Robo Taxi, which is backed by Alibaba, to collaborate on large-scale robo-taxi deployment. Now, before you get too excited about AI and tech multiples, let's understand what CDG is actually doing here. CDG is not trying to build the autonomous driving software. That is a black hole for capital. Instead, they are positioning themselves as the operator of choice. You see, tech companies like Hello or Pony, AI have brilliant software engineers, but they hate the messy physical logistics of the real world. They don't want to clean cars, charge batteries, change tires, or manage fleet logistics. CDG loves that stuff. That is their bread and butter. This creates a moat. This is an asset-light way to play the autonomous vehicle boom. CDG doesn't take the technology risk. They just sell their operational reliability. If the software fails, CDG still gets paid for managing the fleet. My take is that this offers positive optionality. It won't boost earnings much in 2026, so don't buy it for next year's dividend bump. But it future-proofs the business model against disruption, ensuring that when the robots do take over, CDG is the one keeping them running. So, bringing this all together, how do we assess the current landscape for the Singapore investor? Let's look at what is working. The barbell strategy we have discussed on this channel is playing out perfectly. On one end, you have the defensive income plays like Singtel. Their balance sheet is a fortress. They are locking in low rates and they are protecting that dividend flow. On the other end, you have the cyclical growth plays like Seatrium. They are capitalizing on the global energy transition and industrializing their production to boost margins. These are the two pillars holding up the portfolio. What is not working, or rather what is facing headwinds, is the pure consumer discretionary sector in the region, exemplified by ThaiBev. The macro demand in Vietnam and Thailand is soft, and companies are forced to spend heavily just to stand still, This is the drag on the portfolio, and it requires patience. In terms of valuation, the Singapore market, particularly the STI, which slipped slightly to around 4,185, remains a value play. We are seeing a 2025 GDP outlook lifted to around 4%, which supports the medium-term story. However, with the Fed rate cut hopes back in play after softer US data, we are seeing a rotation that favors REITs and yield plays. So here is my final recommendation: split for those of you already in the market and those looking to enter. For existing unit holders of these blue chips, hold. The thesis for Singtel and Seatrium has actually strengthened with these announcements. For ThaiBev, unless you need the cash immediately, selling now is selling at the bottom of the cycle. You're paying for the brand investment now, so you might as well stay for the recovery. For new buyers, be selective. The risk-reward for chasing the broad market right now isn't perfect. I would wait for pullbacks. Specifically, look for rate-sensitive entries on dips. If Seatrium pulls back on any short-term oil price volatility, that is your entry for the long-term industrial cycle. For Singtel and ThaiBev, these are slow movers. Don't chase gaps. Set your limit orders low and let the market come to you. And just a quick personal note before we wrap up. I will be traveling for a 12-day vacation to Europe, so there will be a hiatus in the daily market digest and videos. I appreciate your patience, and I promise to come back with fresh eyes and on-the-ground observations. If you found this deep dive valuable and want to stay ahead of the curve when I return, consider becoming a free or paid subscriber to the Substack. You'll be in good company. The Investing Iguana has now hit over 1.3 million reads with 65,000 likes across our platforms. We are also thrilled to welcome our growing community of over 30 YouTube Premium subscribers and 19 paid Substack members who make this in-depth independent research possible. Thanks for watching, stay disciplined with your capital, and I'll see you in the next analysis.